Oh, joy. Richard Saperstein has darkened the door. This is going to be sport, folks. We say good morning. Going to get the market open here. Futures negative. The futures crater when Saperstein walks in the door.
400 down on the NASDAQ, 1.35%.
Negative 40 here. We're 15.83 on the VIX. I have been so waiting to talk to you. This is wealth management, folks. It's like, not strategy. It's like, and I love your note where you say stay fully invested in equities. You and I remember in our youth when we were still getting carded at that bar, that sidebar at the Waldorf Astoria next to the clock.
I know.
You know that bar, do you?
Sure.
You and I know option writing is the great game. If I option write, I bring in a new income, I give up some equity upside, and it comes through every 10 years with a new iteration. It's right now so much the rage. Goldman Sachs just went out and bought an ETF provider that's given us 9, 10, 11, 12% returns. You and I have seen this before. Richard Saperstein of Treasury Partners on the comfort, the nirvana of option writing.
Well, it falls into the category of newfangled investments that keep coming back, get recycled, much like venture capital, private equity, all the alternatives. But in a market like this, where stocks keep appreciating over the last few years, 13, 14, 15% a year, it's very important. You don't have to leave fish to find fish. There's fish right in front of you. So option writing caps the upside of an equity holding. Right now, my preference is to keep it very simple, stay with the growth environment of the stock market, and couple that with high-grade municipal bonds. Keep it simple.
So we're seeing yields here.
Keep it simple.
Keep it simple.
Stupid.
I left that out.
That's my job.
Okay. Okay.
I mean, boy, Tom and I were just looking at a 10-year. You can clip a 4.75% coupon on the 10-year. Are you suggesting your clients take credit risk above that, or just?
Very safe municipal bonds are 4.50 to 5% now. Yesterday, I saw some 5% coupon housings at par. So if you're earning 4.5%, 5% tax-free, that's 9, 10% pre-tax equivalent, low vol, low risk, high recurring income. And the benefit of that is, if you have a problem in the stock market over the next 3 to 5 years, where stocks go down significantly, you'll have money move into the fixed income market, drive the prices up, and you'll be able to reallocate your portfolio back into equities. You will have what we call dry powder.
What is let's put it this way, is a 60-40 portfolio? Did 2022 kind of put the nail in that coffin, or do you still think that kind of diversification makes sense for your clients?
Most of our clients are balanced actually the other way.
Okay.
Rather than 60 equity and 40 bonds, we actually are the other way around right now in this part of the cycle. I think the big question is, are you double barreling your exposure to hyperscalers? If you own bonds at 40%, stocks at 60%, or either way, because large cap tech makes up a large portion of the equity markets. And for high net worth investors, that's wrong, because for the bond side, we're owning munis. And munis have zero to low correlation with the equity market. So the whole concept of double barreling your risk in hyperscalers on a 60-40 is false.
What do we do then? Well, how about, I guess something that's new during your career, maybe just more prevalent during your career, is alternative investments. I talk to RIAs, and I would expect them to tell me their allocation to alts, 5%, 10%. They're telling me much higher numbers than that. How do you guys think about that?
Again,
Alexis, be careful of the steam coming out of Mr. Saperstein's ears.
I can see
just
it.
slide over, because it's
coming into my personal space.
It is piercing. Look, the alts are expensive, they're illiquid, and they have zero transparency. And some might enjoy them. It's good cocktail party investing, but there's questions about their liquidity, their pricing, the long tails. There's a whole host of reasons. So we minimize them, and we prefer to have liquid investments, especially now in this part of the cycle.
Out of OPCO years ago, and Bear Stearns J.P. Morgan Chase took in Bear and all that. Richard Saperstein, Treasury Partners. Let me squeeze this in before the market opening, and I just have to. I mean, the illiquidity factor for high net worth people, to me, is tangible. Illiquidity is not a problem for suits and ties and St. John outfits on Wall Street, but for the actual people, it's a real deal.
Yeah, in the real world, when you find investors that are retiring and they want to understand their liquidity, or when there's a death and you have to transfer these illiquid assets or a sickness, everyone seems to be avoiding the concept of what is your needed liquidity within the context of a full portfolio. And that's really one of the other issues, the untold issues of having 20, 30, 40% in the liquids in a portfolio.
Let's come back. Richard Saperstein with his Treasury Partners. Too much to talk about the application of wealth management. Richard Saperstein with us. Love having him in here on the application of keep it simple, stupid wealth management with definitive, I should say, with wealth, Treasury Partners right now. So I go log Ibbotson. I take the Dow. I go back to 1942 and the Guadalcanal low is the beginning of like the real credit expansion, the real equity bull market here as well. But if I just go to 22, I got an 18, 19, 22% decline in the Dow. I mean, as simple as I can, what percentage of your clientele have never enjoyed or feel like they've never enjoyed now a bear market? It's huge.
Well, this has been a roaring decade of growth, and a lot of it is fueled by new technology. And many investors have never seen a real bear market, and they are not adequately allocated to fixed income within their overall portfolios. But there's been short drops. At the same time, the Fed has been somewhat behind the markets and keeping them elevated due to the wealth effect. But I think that's going to change going forward, where the Fed is going to focus on inflation and employment and less protective elements for supporting markets and accommodating markets. So I would expect to see more volatility going forward. And look, the yield curve is upward sloping, so I think it's a great position right now.
And I'm opening there, and it was flummoxed here. As I saw it, it really got red quickly, and Alexis Christophers, of course, saved us with a data check. The president tweets out, there are no talks or conversations going on or scheduled with the Islamic Republic of Iran. The naval blockade remains in full force and effect. The Hormuz Strait is open and operating. All water mines have been removed or detonated. Thank you for your attention. This is not the usual thing. But I think, Paul, that was the overlay of futures that got us to a down negative 154 right now.
Real quickly, what are data center beneficiaries? I've not seen that term before.
So the core data centers, the hyperscalers, let's call 4 large ones. And then when they're spending money, they're buying product from companies that are feeding into the data centers. And those companies are benefiting by huge growth of revenues, of margins. And so you can look at it as concentric rings. The spend starts with the hyperscalers, and those hyperscalers are buying product from companies that are benefiting.
Richard, thank you so much. Richard Saperstein with us today, founder, CIO from OPCO, the ARC to Treasury Partners as well. An important note. I love how he's single sentence. He didn't say load the boat in equities, but he said you have to participate in the stock market. A lot of people out there struggling with that. Richard Saperstein, thank you so much.